Welcome back to another episode of Investing Explained. Here's today's question.
I love this question, and you're going to see why. So when you're talking about interest rates, I think so many people get caught up in this idea that because interest rates are super low right now, I have to settle for a much lower return. And that might be true if you're buying publicly traded companies or you're buying stocks on the stock market. That is a true statement. But what I would challenge people to do, and this is how I personally think about it, and I know this is how Stig thinks about it too, is think operationally first. How can I create a product? How can I create a service? How can I start a business around an idea that's going to give me a much higher return than 2%, which is where the 10-year treasury in the United States is, and you're probably getting a 3% by being in the stock market. I think that those returns totally stink. And I think that they are a very low return for the amount of risk you assume because of the credit that's in the U.S. economy. That's my personal opinion. So as a result, I'm not settling for a 2 or 3% return, and I'm looking at investing more operationally in my own business and creating assets or services or whatever. I think that's how people need to think. If you don't have that as an option, or you're not comfortable running your own business or any of that stuff, and you want to invest in public markets, what I would tell you is you have to really do a lot of research, and you have to settle for lower returns because of how polarized interest rates have become, which has been induced by central banking policy. So that's how I see this. And you can see this playing out with Warren Buffett. You know, when we were at the Berkshire meeting back in May, somebody asked a question about his recent purchase of Precision Castparts. And the business, I think he paid a PE of around 30 on the business, which, you know, gives you about a 3.3% return, assuming that all the net income is free cash flow and whatnot. But that's a really important thing. And when the person asked Buffett, he said, you know, is this something that is a new norm, that we're getting a lower return, we're paying higher premiums on businesses? And Buffett and Munger basically said, yes, that's a new norm, and we're going to have to pay higher premiums to own these businesses, and we're going to get lower returns. So that's my thoughts on interest rates. I'm really curious to hear what Stig has to say on this one.
So I'm really happy you brought this up, because a lot of investors really don't think too much about the interest rate, especially now that it's so low. So it's almost like, let's just forget it's there. Let's just act if we're investing like there's no interest at all. It's more or less free money. But what you refer to is really crucial. So what Warren Buffett talks about is the so-called 17-year cycles. And the first one that I would like to mention is the one from the mid-60s to the early 90s, and specifically 81. And you saw the interest rate go up from around 4.5% and up to 15%. And this is on the 10-year treasury. You just saw like the interest rate being hiked again and again. And what happened to the stock market? It was more or less flat, even though the P rose and corporations were making more and more money. The stock market barely moved. And then from 81 and then to the next 17-year cycle, then to the late 90s, as some of you might remember, we were approaching the dot-com bubble here. And you saw the exact opposite. So the interest rate was just slammed. And it went down to around 4.5% again. And you saw the stock market perform 11x in only 17 years. I mean, it's almost impossible to fathom that it can go so fast. And a huge part of that, at least according to Warren Buffett, that was because of the interest rate. So Corey, regardless of what the interest rate is going to do, we don't know. I think there's a lot of opinions whether or not it will stay down and go up or whatever will happen. In the current environment, what it means today is that you have the discount rate that you're talking about, the interest rate, and you also have growth. And when you don't have the availability, for instance, as you saw from the early 80s to the late 90s, to lower interest rate, you simply need to expect another type of growth. So to expect, call it 10% or whatnot, if you're looking at something for a long period of time, it's just going to be really, really hard, because the central bank can't go in and support the economy the way that they've been used to. They simply used that remedy too many times now. So I think in your valuations, you should probably just be more modest in your growth expectations in the future. That's it. Preston and I will continue explaining investing, so go ahead and hit that subscribe button.